Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith. Let's get to the three things that you need to know today. First up, traders are closely watching the latest developments in the Middle East after President Trump said he was unhappy with continued attacks by both Iran and Israel following his announcement of a ceasefire. Hours after the truce went into effect, Israel said Iran fired missiles at the country and vowed to respond with force. Meanwhile, Iran accused Israel of attacking it in 3 waves. But on Wall Street, investors, they're optimistic. U.S. stock futures jumping this morning amid the announcement of the ceasefire. Meanwhile, oil is falling with safe haven assets as traders increasingly unwind trades tied to the Middle East conflict. The events followed a turbulent stretch in financial markets, which have been roiled for nearly 2 weeks by fears of an escalating war. And the Fed chair heads to Capitol Hill. Jerome Powell is set to testify before Congress as he faces increasing pressure from the president to cut interest rates. Traders are boosting bets that the Fed will ease policy next month following remarks from Fed governors on the possibility for a July rate cut. But Powell saying today, policymakers plan to stay on hold until they have a better handle on the impact tariffs will have on inflation. Let's get a check on stock futures here this morning. We are inside of 30 minutes until the start of trade here in the U.S. Taking a look at the U.S. major averages, we've got the Dow futures higher right now by about 0.6%. The S&P 500 futures also higher by about 0.7%. We'll round that off too. And the NASDAQ futures nearly 1% higher. Let's flip on over and take a look at how bonds are moving here this morning as we've got the 5, the 10, and the 30-year yield all bouncing off of some of that move that we had seen, at least to the downside, to start off yesterday's trading session and for much of the early moments of the session here. But now taking a look at the 5, the 10, and the 30-year yields, we're seeing fractional gains across the board on a percentage basis for those yields. We also want to flip over and take a look at some of the commodities that we're tracking as well in the form of Brent crude and WTI. You saw a little bit of a retracement there up on your screen a moment ago. We'll continue to track that. Let's turn now to our top stories of the day. The geopolitical risk trade unwinding after President Trump announced a ceasefire between Israel and Iran, and Federal Reserve Chair Jerome Powell saying he expects the central bank to keep rates on hold. I'm joined now by markets reporter Josh Schaefer and senior reporter Ali Canal live from the NASDAQ. Ali, let's start with you. You are following some breaking news here. Powell expected to say that the Fed can wait on rate cuts. What do we know?
Yeah, so we are getting some of those prepared remarks from Jerome Powell. He said, quote, "For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance." So this largely repeats what he said in that post-decision press conference last week. We do know that there are several FOMC members, including Fed Governor Chris Waller, Michelle Bowman, who have advocated for more rate cuts, saying that inflation has been decelerating and that they are in a position to cut rates. But Jerome Powell has consistently said that he wants to see more economic data. He wants to see how the tariffs are going to impact the economy, how that will have an impact on GDP growth, inflation. And even with those Fed projections, which are still pricing in 2 rate cuts by the end of this year, there seems to be more divergence among some of those members. We have 8 calling for 2 rate cuts, but 7 FOMC officials think that we will continue to remain on hold there, along with those interest rate projections. We also saw that they expect slightly higher inflation, slightly lower growth, and a slight edge higher in the unemployment rate. So that suggests potentially a more stagflationary environment heading into the back half of the year. Of course, Jerome Powell is going to be grilled on all of this. He has faced a lot of pressure, especially from President Trump, to cut interest rates. But we still have a lot of unknowns out there in the economy. And we have that Fed meeting coming up in July. And then in August, we're going to have Jackson Hole as well. So still a lot more market moving events to track here.
And so let's talk about that market movement. Josh, what are the anticipations even coming into the next meeting for the Fed? And now with this latest commentary that is going to be really talked about at length on Capitol Hill today as well, which we'll get to our own Jennifer Schonberger in a little bit. But how are the markets seemingly trying to wrap their minds around the early commentary and the early reaction here that they could hear even more details around later today?
Yeah, Brett, so you didn't see a lot of movement in S&P 500 futures based off Powell's commentary, right? You didn't see a large move come 8:30. So it will be interesting to see what happens throughout the rest of the 2 days, but I don't think we learned a lot necessarily from those prepared remarks, right? We've had several Fed officials come out in the last couple of days being a bit more dovish. That hasn't really been driving the markets. What's really been driving the markets has been oil futures, right? And we've been watching that closely as that conflict in the Middle East perhaps subsides. This has been the major market story of the past couple of days. It'll be interesting to see if the Fed can sort of take the narrative away here and start becoming a market driver again. But for now, we've been keeping our eyes on oil, and it's lower again today.
All right, Josh, Ali, thanks for setting this up. We've also got our Fed correspondent, Jennifer Schonberger, live from Capitol Hill, where we're going to be expecting and we're going to be hearing from Fed Chair Jerome Powell to add on to what we've been breaking down here. So less than an hour until he begins speaking to members of Congress here. What are we expecting, Jennifer?
Yeah, Brad, honestly, not a lot new here from what we heard last week from the Fed chair. He's expected to reiterate to House lawmakers this morning that the Fed is well positioned to wait to adjust interest rates until officials gain more clarity on the impact of President Trump's tariffs on the economy. He will say in his opening testimony before the House Financial Services Committee that, quote, for the time being, the Fed is well positioned to wait to learn about the likely course of the economy before considering any adjustments to our policy stance. Now, Powell reiterated that he does expect to still see tariffs increase prices and weigh on growth this year. However, the impact is going to depend on the ultimate effective tariff rate. He says we could see a one-time increase in inflation from tariffs, or we could see longer lasting inflation, and that is going to depend on the ultimate effective tariff rate, how long it takes for tariffs to translate to actual prices, and inflation expectations. He says it is the job of the Fed to make sure that any one-time increase in inflation from tariffs does not turn into longer lasting inflation. Now, Fed Chair Powell reiterating that the Fed is content to wait and see as he faces continued intensifying pressure from President Donald Trump. The president chiding Fed Chair Jay Powell again overnight on social media, posting on Truth Social that, quote, too late Jerome Powell of the Fed will be in Congress today in order to explain, among other things, why he's refusing to lower the rate. Europe has cut 10 times. We have had 0. No inflation, great economy. We should be at least 2 to 3 points lower. He went on to say, I hope Congress really works this very dumb, hard-headed person over. We will be paying for his incompetence for many years to come. And Brad, this coming after last Friday, the president said that he doesn't understand why the rest of the Federal Reserve Board doesn't override Chair Powell, and that maybe he should reconsider firing him early, but that his term will end shortly. Of course, Chair Powell's term expected to end next May 2026.
Yeah, that's right, Jennifer. We're going to be continuing to watch closely and checking in with you throughout the day. The Federal Reserve's semi-annual monetary policy report in front of the U.S. House Committee on Financial Services set to begin at 10 a.m. We'll have live coverage for our viewers. Jennifer, thank you. As the geopolitical risk trade continues to unwind, let's look at the connection between oil prices and stocks here. Josh Schaefer, our markets correspondent, still with us here in studio. What are we watching there, Josh?
Yeah, Brad, so I was making the case earlier for how oil has become the driver in the stock market, at least in the short term, right? So what we're looking at here is a look at WTI crude and the S&P 500 on Monday. And so you see a key driver of that was in green. You have WTI crude. That came significantly lower, especially at 12:30, as we started to get perhaps an indication that maybe the escalation was becoming a de-escalation. You get a big move lower in oil. That became your low of the day for stocks. Then essentially, as oil continued to fall, you saw continued gains in the S&P 500. I'm going to flip over and just show you futures this morning, Brad, because we're really seeing similar action when it comes to that, right? So you're looking at S&P 500 futures up about 0.7%, and then you flip over to oil. I'm going to find oil for us on our board here. Oil is down about 4% again. So you're seeing this trade continue to be pretty consistent right now. I think really what we're seeing is, yes, we're not sure about escalation, de-escalation. Are we getting that ceasefire? But it feels like for now, at least the market's biggest fears about a push on oil supply, whether it be from the closure of the Strait of Hormuz or some other lever that Iran could pull, that does not seem to be happening. So you're continuing to see oil fall and stocks rise right now.
All right, Josh, thank you. Continuing to track the correlation there. Well, since we're talking oil prices tumbling today despite renewed tensions in the Middle East this morning and overnight after Israel accused Iran of breaking a ceasefire deal and firing missiles. President Trump making critical remarks aimed at both nations and reiterating on Truth Social that the ceasefire is in effect. Wall Street appears hopeful around a ceasefire with stock futures moving higher while oil prices fall. Here to dig into the moves in oil, we've got Andy Lipow, who is the president of Lipow Oil Associates. Just first and foremost, just take us into your assessment of the developments over the past 24 hours with the calling for a ceasefire and the markets responding to the ceasefire announcement, but then what continued to transpire overnight and how the oil markets are reacting there.
Well, good morning, Brad, and thanks for having me. The oil market sell-off started about lunchtime yesterday as Qatar was seeing missiles being shot at it from Iran, but it was a limited number of missiles, and the oil market interpreted that as really a symbolic retaliatory strike that was intended to be more symbolic for the people of Iran rather than to cause damage to American facilities. With that happening, the oil market began to discount the possibility that the Strait of Hormuz was going to be shut down, and then hostilities might even be cooled in the region. That was followed by about 5 hours later with President Trump announcing a ceasefire, and the sell-off in the oil market continued. Now the oil market is going to look ahead to determine how long the ceasefire can hold, and will it actually lead to a reduction in the hostilities in the region?
And so do you believe that longer term for oil markets that we can take off the table us having the risk of getting to $100, $125 a barrel type of prices for contracts?
Well, I think the probability that the Strait of Hormuz is going to be completely shut has been reduced quite substantially. And that's why you're seeing oil prices come off as much as they had. If we look beyond the Strait of Hormuz, the oil market is well supplied. We're getting increasing supplies out of Argentina, Brazil, and Guyana. At the same time, the International Energy Agency is only forecasting oil demand growth to be about 700,000 barrels a day. And this is coupled with OPEC Plus restoring their voluntary production cuts that they instituted several years ago. They've already restored 1.4 million barrels a day of production since April. The plan is to restore another 800,000 barrels a day, probably by October.
Andy, I wonder what your belief is in terms of the companies that are likely or unlikely to do what President Trump was asking for via social media, once again, in the drill baby drill commentary, which once again was, of course, tossed out there by the president as all this was taking place on the geopolitical and Middle East conflict front. Are companies actually likely to do that?
Well, I think the Trump administration is helping to ease regulation so that the drilling companies can lower their costs. But on the other hand, the drilling companies really are looking at the price of WTI because that's how they monetize their crude oil. And if crude oil prices remain around $60 a barrel, they're unlikely to increase their capital expenditures to drill more wells. On the other hand, if they saw a substantial increase in oil prices and sustained levels at above $80 a barrel, the reverse would happen, and I think they would increase their capital expenditures and increase their drilling activity to get more oil out of the ground. But they're really, at the end of the day, driven by the price of oil as well as the price of natural gas.
And so all of this in mind and the timeline that we've seen play out, did oil prices remain elevated long enough for it even to have a material impact to the futures contracts, so much so that if a contract was priced at an elevated level, that taking delivery would be so expensive or elevated expense that would then pass along to consumers? Because that's perhaps what investors would also have to wrap their minds around too, in the time frame for how long prices were elevated.
Well, prices were elevated. I think some hedging activity did occur over the last day or two, but I don't think that the prices were high long enough for oil producers to make decisions on long-term capital expenditures So I think that this real spike, which was very short term in nature, really did not do anything to move the needle regarding drilling here in the United States.
Andy, good to speak with you as always. Thanks so much for taking the time this morning.
Thanks for having me.
Coming up on Morning Brief, we count you down to the opening bell on Wall Street, just 15 minutes out from the opening cross. And we'll take a look at how things open right now, looking for the green, and plenty of it on the screen right now. Now time for some of today's trending tickers. We are watching Starbucks, Tesla, and Carnival Cruise Lines here. First up, Starbucks denying a report that it will sell its China business. In a statement to Yahoo Finance, Starbucks saying, quote, "We see significant long-term potential in the market and are evaluating the best ways to capture future growth opportunities." A China-based financial magazine initially reported the coffee giant was considering a full sale of its China business. Starbucks cut prices on tea-based drinks in China this month in hopes of raising its sales numbers. Next up, the National Highway Transportation Safety Administration confirming it's in contact with Tesla over safety concerns regarding its first round of paid robo-taxi rides in Austin, Texas. The NHTSA says it will assess the issues and take any actions needed to protect highway safety. The news comes after videos that appear to be of Tesla robo-taxis stopping short or experiencing issues, and they were posted to social media. The city of Austin has not confirmed any safety incidents tied to the robo-taxi launch Sunday. And finally, according to an SEC filing here, let's talk about NVIDIA for a hot second. CEO Jensen Huang sold 100,000 shares of NVIDIA stock. It's part of a previously announced plan that allows Huang to sell as much as 6 million NVIDIA shares worth $865 million. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, KB Home cutting its revenue outlook for the year after reporting weak second quarter results. This is the housing market. It remains sluggish, with existing home sales seeing their worst May since 2009. Joining me now, we've got Meredith Whitney Advisory Group CEO. Meredith, good to have you back on Yahoo Finance with us. We just heard remarks from Fed Chair Jerome Powell that he plans to keep rates on hold. So what is the risk that that poses to the housing market?
Well, the housing market looks like it's going to be up for its worst year in decades. So last year, 2024 was bad. The prior year, 2023 was bad. We're on pace for about 4 million units of existing sales this year. And I think actually we're going to come below that. That's significantly below estimates. And that poses a real problem for the general economy because it's such a big contributor to GDP. So not only do you have when someone when a family moves, they buy a lot of furniture, do renovations, spend at Home Depot. The NAR estimates that it's about over 14% of U.S. GDP comes from home sales. So it has ripple effects across the board. I think that the Fed is in a tough spot, and I don't think the housing industry is going to benefit because you have I think wage inflation and real inflation from goods inflation, and then you have a slowdown in the economy. So we don't expect the housing market to improve that much, if at all. We think it's going to weaken throughout the year.
What role does the generation that is still kind of sitting on homes, locked in low interest rates? We've heard that the baby boomer and the kind of silver tsunami even generation is less likely, according to some of the recent surveys from Redfin as well, to actually sell their homes or list their homes because they are in such a sweet spot right now. How much of that is also impacting the equation?
You bring up a great point. So we estimate that over 60% of existing homes are owned by households over 60. And what you see now is the AARP cites that they want to age in place. And what's more, the Joint Center for Housing Studies at Harvard says that only 1 in 10 seniors can afford assisted living. So they're in a situation where they can't afford to move. They want to stay in place. And a very surprising trend is that seniors are taking out equity in their homes, which they have a lot of, to be able to stay in their homes, make renovations, to be able to safely age in place and afford, hopefully, if there are any workers left, at-home care.
You know, additionally here, Meredith, since we're talking about the generational breakdown here, you think about so many of the new home buyers, first-time home buyers, and I think about millennials as well here, who are also still much of the generation, and Gen Zers who are starting to become first-time home buyers as well, saddled with student loan debt. This has been something that's called out upon the banking sector outlook. I was taking a look at Apollo chief economist Torsten Slok's outlook here, saying that student loan repayments are actually going to push many borrowers or repayers into default. And so that could be happening soon. That could impact wage garnishment as well. To the extent that that overflows into the housing scenario, what kind of picture are we looking at as a knock-on effect?
Well, I look at that split in generations as the avocado toast generation. It's people between 24 and 38, and they don't own homes for the most part because they can't afford to own homes. But what they have been doing has been spending all of their discretionary income. And of course, not owning a home, you have more discretionary income. It's been cheaper to rent than it has been to own at homes because of escalating property insurance and property taxes. So you're going to see spending from the avocado toast generation that has been with the high-end generation really like driving this, the high-end consumer really driving this economy. That's going to slow down. And I think Torsten's right about student loans. Now, the other issue is when a consumer loses skin in the game, and there's been such a forbearance for student loans for so long that once they are required to pay the student loans again, there's somewhat of a shock to the system, and there's a natural default cycle versus if they were paying a minimum amount into this down for their student debt. I think that's just a consumer trend that you see in so many so many lending products. But student loans, 1.6 trillion outstanding, is going to be a big bite for the economy for sure.
You've got a compounding of issues that home buyers are thinking about right now, whether that is how much they're going to be paying for a home and the affordability of it as either driven by what tariff policy flow through or the input costs for wages could mean, especially as we're seeing a crackdown on immigration. And then additionally, just where they would like to live, of course, in location itself. All of those things considered, is the dream of owning a home, is it still attainable for those who are really trying to figure out where they can get the best bang for their buck right now?
Well, where people want to live, it happens to be the most expensive properties. If you want to move to Erie, Pennsylvania, you could probably afford a home. If you want to move to parts of Ohio, you could probably afford a home. But where people want to live is there's a shortage of housing supply, and you have a combination of high home prices and high rates. Typically, when rates go up, values go down. That's the how the math works, and that has not happened. So rates have gone up. How home prices continue to go up, and actually, there's not that much activity, and that's what's keeping the home prices skewed towards the high end. The low end, there's very little activity. So people with means are moving, and people without are staying put and struggling to stay and age in place.
As we think about what's working its way through Congress right now, and what's been called by President Trump the big beautiful bill, does there need to be more of an effort to incentivize home purchasing?
Look, I think that home purchasing is good for any economy and any socialization, right? You put down roots, you're committed to the community, you're committed to paying your loans, you're committed to holding down a job. It has so many good things. Now, I just don't think that this environment, and also, people are the 5Ds, diamonds, diapers, divorce, forget what the four and death.
Yeah.
Those aren't happening because people are putting off getting married. So what you see is single women are buying homes, but married couples are that dream is being put on ice.
Yeah. Meredith, thank you so much for taking the time here with us today. We got to sprint to the opening bell. Thank you.
Great questions. Thank you.
That does it for Morning Brief, everyone. Opening bid is next.